the household budgets are getting stretched, and we're hearing about that affordability stress, and it's very much in the news cycles at the moment. So on the one hand, the only way to reduce the pressure on rents increasing is to have a greater supply of rentals. Some investors have got investment properties, and that may reduce the supply in the shorter term anyway. So what happens when we've still got this supply shortage going on, but the pressure to increase prices more? How do these all collide, and where do you see it going across this year?
Welcome to Perth Property Insider, where you will learn how to grow your wealth and improve your life using Perth property. Our show is brought to you by Investors Edge Real Estate, the highly rated and award-winning property management, sales and buyers agency servicing the whole of Perth. Now, here's your host, Jared Mann.
G'day and welcome to Perth Property Insider. I'm your host, Jared Mann, and today I've got my good friend Michael Yardney on the show because there's a lot to be worried about everywhere we look at the moment, potentially. And Michael's been through over 4 decades of investing, seen a lot of these things come up in different ways, shapes and forms before. So I wanted to get him on to give us some larger perspective as to what we should be worried about and what we shouldn't. So thanks for joining me today, Michael.
My pleasure again, Jared. And fortunately, it's over 5 decades of investing now. And if I may correct you, yes, some people are worried, but are there lots of things to worry about? Let's talk about it because maybe they're not.
Well, we've had interest rates rise after being on a more downward trend for the last year or so. And then we've got the talk of capital gains tax reform, filling up every post on the online groups, and a lot of people potentially worried about that. And then we've got always a backdrop of growing global uncertainty and what will Trump do next. And if nothing else, it's very interesting to watch from the sidelines, but I know a lot of people can get distracted by that as well. So do you think 2026 is shaping up to be a pause year or another growth year, or does it represent an opportunity when there is some more of this noise for investors to make smarter decisions?
Well, you're right. We've had an interest rate rise, tax reform chatter, political instability locally as well as overseas. But let's be honest, the property markets have always had something thrown at them. We've known each other for a long, long time now. But even if we just look back over the last few years, a pandemic in 2020, 2022, 23, the fastest rate hiking cycle in history, 2024, 25 cost of living pressures, tight credit. And yet our property markets sit materially higher than they were pre-COVID. And just look what's happened to Perth property, where a lot of people watching us and listening to us have got their homes and their investments. So yes, when you first come across this news, it is potentially concerning. The fact is, having been through the cycle a few times, as you've suggested, it's not as worrying to me now. But the news cycle is so quick and so fast. When I first started investing in the 1970s, you didn't hear about this unless you bought the newspapers and you read it and the news was old. So I guess it was easier not to be scared by all the headlines. But what I've learned is that property markets don't move on headlines over the medium to long term, but on the underlying fundamentals. However, in the short term, I think market sentiment is likely to slow our markets a little bit, at least for the next little while of this year, Jared.
Well, let's chat a bit more about interest rates for a minute. Let's peel back the layers on that. So if rates actually do start rising again, and it'll be interesting to get your thoughts on how that might look, but where do you think the real pressure is going to show up first? We've got a few different buyer segments. We've got, home buyers, we've got investors, we've got developers, we've got, more of the corporate larger projects that go on. Everyone gets impacted by interest rates if they are doing any kind of borrowing. I mean, not to mention business owners as well that have debt to fund things. So where do you sort of see some of this going, and where do you think the pressure might show up?
Well, one rate rise in isolation isn't going to derail our property markets. Just look back at this time last year, and interest rates were 0.5% even higher than they are now. I think what matters to investors and buyers and sellers of homes is the potential trajectory of interest rates and their expectations. If 2026 sees rates plateauing near their peak, maybe one more rate rise, or maybe even a modest easing in the second half of this year, then confidence is going to improve again faster than most expected. Remember last year when people thought interest rates were near their peak, and we thought that last year. Look what's happened. The market moved because people thought, okay, I'm going to get through all this now. The property markets don't wait for perfect conditions, and they move when uncertainty reduces. So it only affects mortgage repayments and affordabilities at the margin. The 0.25% rate rise we've had isn't going to knock people out of the market. And rising rates don't affect everybody. Half of property owners have no debt against their home. And a lot of them, especially in Perth, if they bought 5 years ago, 3 years ago, have got significant equity, so their loan-to-value ratios are comfortable. And remember, property values are created by those who can actually afford to buy, not those who can't. And currently many people have got significant equity in their properties, again, particularly in Perth, so I don't see it affecting many segments of the market.
Well, I guess we've got not just interest rates starting to increase again, but the cost of living pressures and a lot of things fighting for the spend on our wallets. Is there any sort of tipping point where all of this starts to mean that people, can't afford to buy or decide not to buy? Is this, at what point do you think it might start hurting property values and showing up more in the market?
Well, interest rates affect different segments of the market differently. And we know that rising rates alone won't stop the market. We've seen that in the last couple of years. It'll be more related to confidence and buyer-seller expectation of what's ahead. Currently, we've got really good employment growth. Employment, particularly in Western Australia, has gone up strongly. We've got in Western Australia a very strong level of population growth, internal and external migration, and not building enough properties. But if everyone who wants a job can get a job and wages are going up, that will underpin the market. But let's put some figures to this. Apparently, the average new mortgage is close to $700,000. A full pass-through of this first rate rise, 0.25%, adds roughly $110 a month to repayments on a typical 30-year loan. Jared, that's not going to change the market. Of course, at the same time, borrowing capacity takes a hit, and a median income household will lose about $18,000 from their maximum borrowing capacity. Again, that's not going to change the market considerably. But it's got flow-on effects. It will push more buyers maybe down the line a bit to mid-tier homes or towards lower-priced properties, apartments, townhouses, villa units in the states where they've got those houses further from the city. But it will affect others. You've already hinted at that, Jared. Construction costs, labour shortages, development feasibilities, that's just going to choke off new supply. And raising interest rates is not going to fix that problem of lack of supply. And with listings of properties below long-term averages and the supply-demand pressures firmly in place, I don't think a couple of rate hikes are going to materially change the overall market balance, Jared.
Yeah, I agree with that. And thanks for breaking down just what it actually means in terms of reducing borrowing capacity by only $18,000 and $110 a month. If someone really wants to get into a house, they could forego their, not buy a coffee every day and then you've got your money back. But
I guess what I should have said, though, Jared, is I see this as a period of genuine opportunity for those who are prepared. If you're finance ready, there's going to actually be fewer competitors in the short term, while people are a bit concerned, which could mean better negotiation, better property selection, less competition. Maybe vendors who are a little bit more prepared to negotiate.
And it might just take some of that more extreme bidding that we're seeing out of the market here in Perth. It's a little bit more reserved. They're not going to come in and pay a crazy price and be a little bit more conservative on what they offer. So I don't think it's going to change that. They'll still be wanting to buy. If they're that concerned, they might change, as you said, what they look to buy and their actual type of property that they're looking for if they really want to downgrade their price. But I don't think we're definitely not at fundamentally changing things yet.
Correct.
Well, that's good to know. Now let's tackle the other big area of capital gains tax, CGT. Where do we begin on this? I'll ask you the big question. Do you genuinely expect changes to capital gains tax in the May budget to be announced? Are they just testing the water here and going to not proceed, or do you think that they're going to go full steam into this?
I have no insider knowledge, so I've got the same knowledge as everyone else. They are testing the waters. This is what the government does to see what public reaction is. And at the moment, in general, the public reaction is in favour of lowering what they call an incentive or a discount to investors. That's something we can talk about in a moment. But basically, tax reform, we hear about this every cycle, but in general, sweeping changes like removing negative gearing or a major reform in GS capital gains tax, they're politically dangerous. So they're testing the waters. And at the moment, it's easy to blame migration on the one hand and property investors on the other hand for the housing shortage. But most reforms tend to be incremental and they have unexpected consequences. Investors may act before the legislation changes. I don't think if they do introduce it, they're going to make it retrospective. In other words, they're going to grandfather people who've already bought properties. Why? Because it seems like the fair thing to do. It doesn't sound fair, if politicians are fair, to actually penalise people who made decisions based on current tax legislation, but they may bring it forward. Will they bring it back to maybe just indexing it to inflation or lowering the discount you get on capital gains tax? They're talking about being fair to younger generations, and if you're fair to them, then you're not as fair to older generations who've made decisions, taken risks based on what the tax laws were then. Of course, it's not going to change the budget. They need money. The government needs money. They're only going to get the money when people sell. And that may be a number of years down the track, and people may not sell their properties as much. It will stop property flipping if that occurs, if they bring in changes to capital gains tax. But that's not a strategy you or I have ever believed in anyway. So I think the governments can't afford to crash the housing market. Too much household wealth, too much bank exposure, too much voter sensitivities involved in that. But they're testing the waters, and it wouldn't surprise me if there are some changes.
Well, some of the things I've seen proposed is a 5-year period before it applies to people. So they've got sort of 5 years before it applied. And I've seen a proposal to halve the discount to 25% instead of the 50%. There's lots of other things getting thrown around. It's hard to know at the moment, what their real intentions are because they haven't come out with a policy, as you say. So I guess we just need to watch the space. I've got people asking me, a lot of people as they prepare for retirement start to look at, are they going to keep all their assets in property and when are they going to sell assets down? And so that's the client segment I'm seeing it affect the most, where they were already planning to sell a property in the next financial year and that's been their plan. And now they're asking me, should we look at it sooner? Is this going to change and affect me then? And it's hard to, again, know on timeframes and whether it might include them or not. So
very much so. So the answer is be prepared by owning the best properties you can, having financial buffers in case you need some extra money up your sleeve. Don't make knee-jerk reactions. Don't make 30-year investment decisions based on the last 30 minutes of news. And again, most property investors hold in the long term. But yes, at various stages in your career, you may sell a property either because it's underperforming or because you're at that stage of your life where you now need to lower your loan-to-value ratios to start living off your property portfolio. But get good advice from people like your team or our team at Metropole, independent advice rather than getting too nervous or excited or disappointed by potential changes.
I think some of the people that this will affect the most is those more speculative investors. And I've done my numbers on the equivalent return you'd need to get if you did try to cycle in and out of markets. And over a 4-year period, if you're trying to time the market and stay in only when there's growth, you'd have to get around a 2.5 times return just to offset the entry costs, the exit costs, and the capital gains tax. And if the CGT does increase, that's only going to increase that return and make it even more speculative to try to achieve that. And so I can see a lot of people that have, for instance, bought in Darwin that have no intention of holding that property longer term. They know it's cyclical. They're trying to time when they get out and they could be, caught out, and it really takes things to being a lot more speculative. So I guess it'll start to change strategy and, how the timeframes that we see ourselves holding a property for. And I think even if the change doesn't come through, if people can move more towards that long-term mindset now with anything that they buy, they'll only be better off for it.
Well, property investment is a long-term strategy, but over the last years, I guess in many ways social media and a whole group of new people have come out to say you can buy properties, get the next hotspot, get out. That's not investment in my mind. That's speculation, and that comes with real risks.
Yeah. So if this did go through in whatever way, shape or form, they change it, they make it less appealing to, sell properties. How do you see it sort of shaking out? I know it's going to depend on the timeframes and whether it's grandfathered, but could this actually unintentionally worsen the housing market in any way?
Well, it won't affect developers because developers are not getting benefit from the capital gains tax exemptions. Just for people to understand, developer profits are taxed at the normal tax rate. So it's got to do with your intention. So developers will still either build more stock to help the housing supply or not, really dependent upon all the other factors. And currently, new developments are not financially feasible in many locations just because of higher costs and the fact that the market hasn't caught up yet to make new developments financially viable. So housing shortages have nothing to do with capital gains tax or tax changes. On the other hand, if it's grandfathered, I think it's going to affect new investor behaviour more than established investors. In other words, established investors are going to be set. If they need to sell for the reasons we've already discussed, they will, knowing that, okay, it is what it is. Having said that, it definitely will affect new investor behaviour, like you've suggested. Fewer people will flip, and I hope it will bring investors to think more about property as a long-term strategy rather than the short-term one. Will it create a housing shortage? Will it affect that? I'm not sure, because really the housing shortage is really more to do with new stock, supply and demand, and people moving homes. Remember, it doesn't affect people's homes, so the majority of people selling properties are still people getting married, getting divorced, having babies, maybe not in that particular order. And so what's going to happen is property markets are just going to keep moving on, Jared.
Yeah. Yeah, no, that makes sense. Well, let's now talk about the rental markets, because we might get some impact from the CGT, especially show up there. But, from everything I'm seeing, people, doing it pretty tough and getting stretched. The household budgets are getting stretched, and we're hearing about that affordability stress, and it's very much in the news cycles at the moment. So on the one hand, the only way to reduce the pressure on rents increasing is to have a greater supply of rentals. And we're just talking above about, some investors getting out that, have got investment properties, and that may reduce the supply in the shorter term anyway. So what happens when we've still got this supply shortage going on, but the pressure to increase prices more? How does this all collide, and where do you see it going across this year?
Well, over the last couple of years, rental growth has outpaced wages growth or inflation considerably right around Australia. Just go back, though, a few years earlier, and rental growth wasn't as high as that. So in some ways, we're playing catch up. And yes, it's hurting new tenants or tenants in the short term. But if you go back over a decade and you're a successful property investor, and I am as well, there were many years, and where I'm living in Melbourne, there were years when rents didn't go up much at all.
Yeah, well, ours went down 32% at one stage too. So we do have to have a bit longer memory, don't we?
That's right. So having said that, at the moment, it really is supply and demand that's pushing up property values, not greedy investors, not tax changes. Vacancy rates are at historically low levels in most capital cities. New supply isn't coming online as fast as the government would like or anyone would like. We've heard before that the government's got this plan to build 1.2 million homes. They were never going to build them. They were going to encourage people to build them. Construction costs are high. Small and medium developers are constrained by finance. Planning bottlenecks remain. Investor activity that brought on all those new developments a decade ago, many of them were sold to overseas investors, to Chinese investors. That's not there. And the build to rent segment that the government's trying to encourage by giving them incentives isn't really going to change the needle much at all. And even if all the building approvals that are coming out were to be built, it takes 12, 14 months to build these properties. Interestingly, the HIA has shown that up to 50% of the value of a new house and land package is taxes. Council rates and taxes, state taxes, GST and federal taxes at all levels. It's actually a form of cocaine that all our government at each level are dependent on. And so the cost of new construction construction is very high based on that, and for investors to run small businesses, because that's what the average mum and dad investor is. They're taking a financial risk, they're taking a loan, they're providing a service, they're going to want a reasonable return, they're not being greedy, but to do that, they've got to get adequate rents, otherwise they're not going to invest.
Yeah. Well, we've also got the changes and reform going on to the Residential Tenancies Act in most states nationally. And let's just say that is it becoming more exciting to be a landlord in that area either. It varies state by state and what the changes actually are. But that, I think, is putting some people off on the edges that aren't, really committed to growing wealth, improving their future. So when we also throw this CGT changes in the mix, those two things I think are going to keep contributing to less supply of rentals. Is that what you can foresee as well?
Very much so. So with regard to all the legislative changes and the reforms in general in favour of the tenants, but any reasonable landlord would be providing a tenant with the right level of accommodation so that they'd comply with these regulations. So I see them as a fee for being involved in the business of property investment, not a fine for being involved in property investment. But with all these changes that we already mentioned, I see the situation getting worse for tenants with rents rising, but I don't expect explosive rental surges like we had in 22-23. Affordability ceilings, you mentioned that a while ago, are real. Tenants simply can't afford to absorb unlimited increases, but we've still got strong migration, low vacancy rates, limited new stock. So rents are going to increase, but I think at a more moderate pace. I think some tenants are going to go back to sharing more. They stopped doing that over COVID. Some will move not be able to rent houses, but rent apartments or townhouses. Some will stay longer with their parents. Others will have to move further out. But I can still see rental growth in all our capital cities, and particularly in Perth, where supply is constrained, Jared.
Well, I wanted to pick your brain for a moment, because what I notice about Melbourne, and we can probably learn some lessons from this, is Perth, and also understanding the sort of dynamics of how, everything interacts. And your prices are still seemingly very undervalued compared to the rest of Australia. But when I look at rental yields, they're still relatively low. And what happened here in Perth before we had an increase in house prices is we had a surge in rental prices, and that sort of led our recovery when the rental yield was more attractive to investors to come in here, and they weren't yet seeing the growth, but the rental yield sort of got them over the line. But where do you see rents in particular going in Victoria, and is there any major pressure on changing that dynamic and increasing the yield by a lot more, or do you think it's going to be more steady as she goes? Because I think that's the one missing ingredient that would get people more excited about investing into Melbourne, and if it improved.
Okay, a couple of factors there. First of all, the Melbourne housing market, just like the Perth housing market and all around Australia, is in general driven by owner-occupiers, not investors. And we all have the same tax rate. We all got the same interest rate. What affects local markets is the local economy and the local government. And currently there's a lot of dissatisfaction with the local government and the local economy. And so that's why, if people aren't comfortable about their financial future, owner-occupiers don't move house. Interestingly, the lower end of the market has been very strong in Melbourne. And over the last 2-3 months, in particular with the first home buyers. In other words, in Melbourne, they can buy a new house. In Victoria with the 5% deposit up to $950,000, $1 million in Queensland, $1.5 million in Sydney. In other words, new first home buyers can buy median price, not just cheaper properties anymore. So that's increasing demand, usually in the same area where a lot of investors, in the same price bracket, a lot of investors are looking at as well, Jared. We're seeing a lot of investors at Metropole, my company, but also I'm just hearing in the industry, a lot of investors who were investing elsewhere now looking at Melbourne for the reasons you mentioned a moment ago, the relative affordability, and seeing Melbourne at the stage where Brisbane and Sydney were, Brisbane and Perth were 3-4 years ago, the beginning of the upturn phase of the cycle. But interestingly, There's not one Melbourne property market, just like there isn't one Perth property market. And last year and the year before, we bought a lot of properties in the homes in the high $600,000 bracket in some of the southeast suburbs of Melbourne. And those properties now, you can't get below 800,000. In other words, the investors we've helped, while the Melbourne market in general was flat, doubled their equity, their deposit, and rents have gone up accordingly as well. So we're finding investors coming here not because of the yields, because of the potential upside and the fact that you can buy below replacement cost in Melbourne. It's just that stage of the cycle that Perth went through after a decade of minimal growth. Brisbane's had periods of low growth, so Sydney. That's just the way, if you look back over the 45 years that the Bureau of Statistics has been producing records, it shows what happens in every state and taking advantage of the cycle, not trying to time it, but just recognizing where you are in the cycle, together with the right fundamentals of looking for areas that are gentrifying. I see some great opportunities in Melbourne at present.
Well, that sort of takes us through to a bit more practical advice. So what are you seeing experienced or higher net worth investors doing right now? Because you deal in the three main states across over east. You deal with
Melbourne, Sydney and Brisbane, yes.
Yeah, and a lot of investors. So what's your finger on the pulse telling you?
While those who've been around the traps a few cycles are not as concerned, some of the business people and high net worth investors are a little bit concerned until we go back and remind them about the fundamentals. It's hard not to be a little bit nervous with all that's going on, especially if you're a business person. But if you've got secure income, if you've financed ready, we're finding they're actually taking advantage of the opportunities. We act as buyer's agents in Melbourne, Sydney and Brisbane, but we start by putting a strategic plan together for the clients, and it tells them what to do and what not to do. And therefore, we help them plan to become, I guess, the investors they plan to become. But by doing that, they just follow the strategy, they follow the plan, and timing isn't as important. And in fact, what's happening in the short term isn't as important if they think about, will the property I'm going to buy be in continuous strong demand in 10, 15, 20 years' time by owner-occupiers to push up the values and by tenants as well. So we select the right areas that are gentrifying, that have got higher disposable income, where people can afford to and are prepared to pay more, and will continue to do so in the future, Jared. So they're taking advantage of the opportunities.
Yeah. Well, I've looked back and we've had a lot of chats over the years, and there's always something on the horizon to be concerned about or nervous about. And if I think about the times that I had some caution about those things, I mean, as an investor, we need to be aware and we need to look at what's on the horizon. But if I didn't act at the times when I bought property previously, then I know my wealth would be a lot lower today. And if you buy each of them for that long-term focus, then whether it grows as much as you think or it takes a while to get, the compounding going, it shouldn't change your decision about that asset. So I think your guidance has really helped me with taking more of that longer term view and still optimizing for the now, but buying something that you'd be happy to keep for 10 to 20 years.
Exactly. Remember, your future income as a property investor will be dependent upon your tenant's ability to keep paying you more rent and higher rent. And so therefore, and it's not a judge of people, but we don't want tenants who are a week or two away from broke. The affluent areas in Perth, in Melbourne and Sydney are not going to change. Close to the water, close to the beach, close to the established money area, close to 20-minute neighbourhoods where you've got great amenity, that's not going to change. And so therefore, there's always going to be more people wanting to live there. By the way, those areas are often a bit more volatile with ups and downs at the moment as there's a bit of uncertainty. The prestige areas of all our capital cities are suffering a little bit. You don't need to change your $10 million trophy home for a $15 million one overlooking the water in Western Australia if the business market isn't doing too well. But during economic booms or, when America's Cup was there, people got exuberant and overcommitted themselves. But the long-term trend of property for 200 years in Australia has been up, and that's not going to change.
Well, thank you so much for coming on today, Michael. I really always appreciate our chats and great to get your larger perspective on things. So if people want to reach out, I'll put your details in the show notes. Metropole, really great operator on the East Coast, and I encourage anyone that's thinking of making a move over there to reach out to Michael's team.
Or listen to my podcast, the Michael Yardney podcast. Thank you very much, Jared. I've enjoyed, as you said, we've had a friendship and a business relationship for a long time. And if I could just say, I've seen how you've matured and you've helped our clients that we have in Perth do the right thing because of your long-term attitude and focus. And there's not many people there who've got that. So it's great being associated with you.
Thank you, mate. Have a good week.
Just a reminder, the information discussed in this podcast is general in nature. As we don't know your specific situation, you should always seek professional advice before taking any action. For free market reports on your suburbs of interest and other helpful resources to grow your wealth, make sure you join my property investor update at investorsedge.com.au/join. And finally, make sure you're a member of our Perth Property Investment Facebook group to be part of the conversation with other like-minded investors, get help to your questions, and get a feel for what's going on out there in the market. I'll see you in the group.